Before we dive in, let us address what every investor is watching right now. AI stocks have had a rough few weeks. NVIDIA down, ASML down, the entire semiconductor complex under pressure. Edward, what is actually happening?
Valuations got stretched after extraordinary runs, and investors are asking a fair question. When does all this AI infrastructure spending actually translate into returns? Add geopolitical uncertainty, and you have a nervous market. But here is the perspective that matters. Warren Buffett said it best: be fearful when others are greedy, and greedy when others are fearful. Right now, there is genuine fear in AI stocks. The fundamentals have not changed. The sentiment has.
Today we are focusing on one of those pulled-back names, Vertiv Holdings, ticker VRT, the infrastructure company keeping AI data centers cool and powered. And due to time, we will cover ASML next episode alongside our new CF Global stock scoring system. Edward, why is Vertiv considered the unsung hero of the AI trade?
Because without Vertiv, the data centers running every AI model you use would literally overheat and shut down. Their power management and liquid cooling solutions are what allow massive AI workloads to actually run at scale. As AI chips get more powerful, the heat they generate increases exponentially. Vertiv is the company solving that problem, and they are solving it at a moment when demand has never been higher.
The numbers back that up. VRT is trading around $300 a share. Q1 2026 revenue surged 30% year-over-year to $2.65 billion, organic growth 23%, EPS of 1.17 beat estimates by 17%, adjusted operating margin expanded 430 basis points to 20.8%, and they carry a backlog of $13.2 billion, giving clear revenue visibility well into next year.
The Americas are leading with data center demand pushing net sales up 44% organically. Analyst consensus is strong buy with an average target of $376. Next earnings August 5th, and Vertiv has front-run the shift from air cooling to liquid cooling with strategic acquisitions, positioning them as the dominant infrastructure provider for next-generation AI data centers.
What are the key risks?
Competition from Schneider Electric and Rittal. Any slowdown in cloud provider capital expenditure hits Vertiv immediately. And at a forward PE of 44, there is limited tolerance for earnings misses. But institutions are not viewing Vertiv as a regular industrial hardware business. They see it as a high-margin technology enabler with structural lock-in as AI complexity increases.
What are retail investors missing that institutions already know about Vertiv?
Institutions are not buying Vertiv as a cooling company. They are buying it as a technology platform with recurring revenue. Once a hyperscaler builds their data center around Vertiv's integrated power and cooling architecture, switching costs are enormous. The relationship compounds over decades, not quarters. That lock-in is what big money is pricing in. And most retail investors simply have not modeled it yet.
And on the macro side, rates, tariffs, supply chain?
Higher rates increase debt servicing costs for Vertiv's customers building capital-intensive data centers. That is a real headwind. Tariffs on imported components remain a margin risk. But Vertiv's $13 billion backlog means revenue visibility that most industrial companies can only dream of. The orders are already placed. The question is execution, not demand.
A stock that has pulled back meaningfully from its highs, with a $13 billion backlog, dominant liquid cooling position, and the full AI infrastructure build-out still ahead of it. Next episode, we bring in ASML, the only manufacturer of EUV lithography machines in the world, and we introduce the CF Global stock scoring system to help you make better investment decisions. Do not miss it.
And amid all this, do not forget the most important investment of all, enjoying the beauty of life.
No AI. Invest in AI. See you next episode.